Hi, everyone. Thank you all for sitting in today. And I want to say a quick thank you to iConnections for hosting this event and for such a wonderful conference so far. So to kick off this panel discussion, I thought we could hear from each one of our panelists about the evolution of their alternative investment portfolio. And maybe you can talk a little bit about your perspective and if there's still room for growth and anything else that you'd like to give us color or information about. Chris, you kick it off.
Sure. So Chris Winiarz with Stable. We're an alternative asset manager, manage about $3.5 billion in capital. And we provide strategic capital to anchor founders in the alternative investment space. We roll out a bit of an old school operating partner model where we help on the ops and the distribution side to grow and scale those businesses and ultimately share in the alignment of those firms and their long-term success. In terms of our evolution, a little bit different from some other asset owners here today. I think we started in the liquid hedge fund space, and as the industry has moved into the more hybrid structures, some of the crossover vehicles we have as well, into today where we're now cross asset class, both public, private, and everything in between.
Karen?
Great. I'm Karen Welch. I work with Spider Management Company, which is part of the University of Richmond. We are unique in that we are part endowment and part OCIO in that we manage capital, in addition to the University of Richmond, on behalf of about 30 other smaller colleges and nonprofit institutions. So we manage about $6 billion, all as a single portfolio. I'm excited to be here with you today to talk about alternatives and the importance they play in our portfolio. We were or my predecessors, our first CIO was really a pioneer in investing in alternatives and predated I think most of us on this stage in that he was investing in alternatives back in the 90s. So they've been a sizable and important part of our portfolio for a long time. Currently, we have about 30% of the portfolio in private equity, a little less than 30% in a range of hedge fund and private credit strategies, and about 15% in real assets. So given that size, we're not actively looking at growing that level, but we are continually looking at how to best allocate across the private asset classes and alternatives in order to generate the strongest forward-looking risk-adjusted returns and ensure that we're partnering with the strongest alpha champions, as we're here to talk about today.
Yes, makes a lot of sense. Derek.
Hi, everyone. My name's Derek Drummond. I'm with the State of Wisconsin Investment Board. I handle all of our external relationships throughout the liquid markets. And so alternatives or hedge funds in my book have been around since 2010, so about 13, 14 years now. And our program really has evolved. It's about $8.5 billion now. And 3 or 4 years ago, with the risk-free rate at 0, a 5 or 6% return kind of got you done. It was really kind of nice. Now, if you think, our target is about 300 basis points over the risk-free rate, so that's 8%. And I like to think we are, but we're not perfect, right? So if I have like a 75% batting average, in order to hit 8%, my managers need to be putting up 12s and 13s this year, and that's very different than it was a couple years ago. And so how we're facing the alternatives market is really, we need to be in control of our cost of capital. We need to be in control of our volatility, things like that. And so the last couple of years have really kind of changed our program and changed how the team thinks about investing in hedge funds.
Okay, makes sense. Preet.
Hi, everyone. I'm Preet. I work at Carnegie Corporation of New York. We're one of the oldest foundations, have about $4.2 billion in assets. And our portfolio, when I joined, we had privates and we still have those. We worked on diversifying our public book. So we've added quant strategies, which account now for about 10% of the portfolio. We've added multi-strategy pods, which are roughly a little less than 10% of the portfolio. And so we've diversified away from just having long short, which was sort of predominantly how a lot of portfolios were structured in public alternatives. And so that's sort of been the big shift we've made over the last 3 years since I joined. And I co-head our public markets with my colleague Bradley, and we're continuing to diversify our public portfolio. That's been the bigger push in the last 3 years.
So you all have pretty big pools of capital. How do you find new talent? What is it that you're looking for? Maybe Preet, we can start with you.
Sure. So I think outside of like the traditional, meeting peers and going to conferences, I try to keep an eye on who's the number two at some of the larger funds, who's spinning out from some of the pods, and sometimes you'll find very interesting people who are who covered a lot of large cap liquid stuff, but going into the more inefficient areas where we think they're going to have a lot more success, and they've sort of also realized, hey, if we just manage a little less money, they can do better, put up a great track record with their own name on the shop. And so it's really just tracking the various talent at the pods and also the number two and number threes at the larger funds.
Anyone else have anything to add on that?
Yeah, so we do a lot of that. That's our job, right? So we have a team of 8, and we have over 1,000 interactions with managers a year. We track it, and I have the saying, whatever I'm not long, I'm short, right? So it's my job to know who's out there, who's moving around. I'm sure just like everyone else, we do monthly calls with all the primes, who's spinning out of where, who's good, who's whatnot. Most of our emerging managers we've found kind of just by our network and finding somebody that has some capital from a couple of our friends or something like that, but they want to keep the pool tight. So that's where we're having the most success, actually. Like, we're really kind of digging around, talking to our friends and saying, okay, who do you have that you really like that might have an extra 100 to of exposure that we can get?
Now, and I would just add 2 things. One, my colleague Jeff hires, who brought 20 years of experience on the buy side to our team. And so he brings a different relationship and perspective and network. And it's great to be at conferences like this and have him run into peers that he had worked with. And so I think that's helpful and gives us a different perspective. And then I would just underscore the importance of relationships and reference calls and having really close partnerships with your managers. That Anna and Raul were talking about that before we came on stage. We get some great referrals from our managers when we ask them who they respect, and even ask portfolio company CEOs who they respect as managers.
Yeah, I think for us, given our model is solely focused on day one talent, we have to source in a little bit of a different arena than I think many of our colleagues. So for us, it's really getting earlier in the life cycle of these founders. And so if it comes through Cap Intro or it's in a database, it's kind of too late for us. So for us, we have some alternative channels. I'm going to say they're proprietary, and you're going to nod your head and say, oh, that sounds obvious. But I'll say many groups don't do it. For example, the first call that a founder makes is through their Gmail account. They're still thinking of spinning out. They're trying to assess their worth in the market. So they call executive search firms. And there's a handful of those groups that specialize in talent in our industry that we work with. The second call they make is to Shelley and her team. There's 12 major fund formation houses in the US. There's another 30 or 40 groups that specialize in certain asset classes or geographies. They're a great source of talent because the first question that a founder asks themselves is, how do I start a fund? Seems pretty simple, but they call Shelley first. And then lastly, which is kind of interesting, I see a few people here in the audience today, there's design agencies that specialize in writing pitch decks for the asset management industry. I mean, there's a lot of quant geeks out there that are really good at one thing, but they're not great at designing decks. So those agencies we work with as well, great source of talent.
Yeah, well, I get asked that question quite a bit about starting new funds. Of course, my practice is focused on not just emerging managers, but managers across the spectrum. But it starts with emerging managers. And oftentimes when someone is rolling out of a fund or a corporation or anywhere where they haven't had to form the entity themselves, it is a major learning curve for them. And there's a lot of hand-holding involved because they don't really know what they're doing. They know how to trade and they know their strategy really well, but they don't necessarily know how to set up a business and what that looks like. And we're going to get into a little bit more of that later on. But kind of along the same lines, I want to know, how has your process for finding managers changed over the course of the last 5 years? We went through, 5 years ago was maybe right before the pandemic, then we went through the pandemic, and now we're kind of out of the pandemic, hopefully. What does that look like for you guys? Anyone want to take that one?
I can start.
Okay.
So, 15 years ago, I think when I remember when I started, things seemed very competitive. But then every single year, they just keep getting more and more and more competitive. And you always feel like, oh my God, how is someone going to create alpha? But it gets more and more. And so right now, we just look at our portfolio and if you're looking to develop markets, long only fund or long short fund that plays in liquid, large caps, it's just really hard. And is that a bet we want to make? And am I the right person to pick out one out of the 25 that is going to succeed? So I think, focusing more and more in more inefficient areas, we've just pushed more and more into that through time. Mm-hmm. And I just think eventually even, you'll get levered players in small caps. And we're already seeing that start with some of the platforms where you're seeing more, they're levering up and allocating more to small caps. So that coverage is also, so you just have to sort of stay on top of which inefficiency is slowly going away. And I think that's the hardest part to track because you don't always get very good data.
Mm-hmm.
Well, speaking of data, right? That's something that's really changed. I've been doing this. This is my 24th year doing this. Data was not, out there when I was 21. Now I can take a trader's track record and we're in the business of buying what I call serial good decision makers, right? So I need to see all the reps they're taking at the plate, right? I don't know if that monthly return last month was 1 stock or 10 stocks or how they did it, right? And so alpha is the, accumulation of, security selection, portfolio construction, and risk management. So we take all that data, all the trades they've done, I need trade history and their positions, and then I can load it up. 1, I can see how it would behave in my portfolio. 2, I can see how they made money over time. If a stock goes against them, are they leaning into that or are they leaning out? And then you can have a much deeper conversation with the manager about their style and who they are as an investor. That's something we didn't do 5, 7 years ago. That was, having the ability to get that data and use it to your advantage is so important now.
Mm-hmm. I think data is a key point, and we're obviously in the midst of a continual evolution there. When I think about what AI will be able to do to help us enhance our processes is really exciting.
They're going to replace us.
We're hopefully not, because actually, but the part that hasn't changed, that I think we all appreciate even more so now post-COVID, is the importance of that relationship building. Yeah. And you can certainly, with Zoom and technology, we can be more efficient and we can cast a wider net and do our early stage diligence more effectively and efficiently. But you look at the 4,000 of our closest friends who are here. It's just a testament to the importance and real value of being together and community and relationships and sitting across the table with prospective managers to really understand how they think, what motivates them, and how aligned we can be with them.
Yeah, I'm not sure I would add more. It's really just about more emphasis on the people. It's a people business, so the ability not just to sit with them, but sit with their spouses and their significant others and their other partners who are building the business alongside them and understand what actually drives them, who they are as people, right? The simple waiter test, little things like that, I think we've just emphasized more over the years.
Okay. So this might be a little bit of a controversial question, but we have a bunch of managers out there in the audience, and they're not here for the cookies. So I think I would ask this question of Chris. What are some of the red flags that you might shy away from, or what would stick out, or anything that you can maybe share with the audience?
Yeah, I don't think of it so much as red flags. For us, it's really trying to find partners and founders who identify in kind of 2 areas. One is, at the core of it, we're looking for a great investor and a great entrepreneur. Because we are building businesses alongside them, we really need both. And so we've spent a lot of time on the data side thinking through what drives those 2 cohorts. And from the investment perspective, it's the ability to think differently. And so there's a lot of research and data, white papers out there that show contrarian thinking leads to alpha. So for us, we want partners who think differently. Mm-hmm. And then I think second, on the entrepreneurial side, it's partnering with people who've overcome adversity in their life, the ability to run through a brick wall and be told no 100 times and still ask the question. And so for us, that's people who have cognitive diversity meet these kind of two definitions. So for us, that's more of kind of what we are looking for as opposed to what we're not looking for. But at the end of it, we need a great investor and a great entrepreneur.
Well, you're focused on day one allocation, so you're really in a different position than maybe some of the other panelists. They may be amazing portfolio managers, but they have not necessarily run a business or had to face some adversity on their own without input from a team. And now they're the driver of the business and they have to make decisions. I would imagine that that's a very hard thing to quantify or to know on day one or qualify if you're going to be successful with a particular manager.
Yeah, I mean, for us, it's not easy. I think we try and focus on our beliefs, the investor and the entrepreneur, and we solve it in our way. But I know, other people on the team here solve it in their own way. I mean, Derek, I know you've done some interesting stuff, backing new talent and putting it on a platform. We overlap on some things as well. So, I get the sense there's a lot of people doing innovative stuff,
Yeah.
Even though we're all kind of fishing in the same pond.
Anyone want to add anything on that?
I'm just really happy that you didn't ask me about my red flags, because about 15 years ago, I was on stage and I made fun of a manager for not wearing socks with his shoes, and I'm looking at it and I was like,
Oh my goodness.
that was a red flag for me, and now I'm a red flag. I'm a red flag. So.
You're safe.
Yeah.
You're safe.
I think at the end of the day, we just want to make sure they're on the same side as us. I think making sure those incentives are aligned and they're not trying to squeeze us on fees, things like that. I think just making sure on the same side of the table. And you can tell who is and who isn't.
Yeah.
And you can see their reaction function, right? You want people, when things get tough, you don't want people to hoard, assets or skills or talent or whatever. You want people that will lock arms with you and say, okay, we just had a rough patch. We're going to fight our way through this. We're going to grind our way back. March of 2020 was a really good litmus test for us for who we wanted to partner with. You got to see a lot of different reaction functions in your managers. Mm-hmm. And some of those managers are sticking around, and we had a couple managers that had big drawdowns, but how they reacted and got their way out of those drawdowns was very telling to me and important for me. And some of those managers that were very selfish, frankly, and wouldn't pick up the phone and things like that, they're no longer part of our portfolio. But these other guys, so it is about the people. It really is.
I think that's right.
In my experience, the cases that I've seen where new managers have really struggled have been when they have been great in fundamental analysts or great portfolio managers and investors, but don't have the business acumen or the necessary risk management frameworks. And so as you think about, red flags for a startup, it would be, you talked about the importance and the challenge of launching a business. That's a whole different skill set. And so to the extent that we look at new managers, I think it's really critical to, in addition to assessing their investment skill set, it's to ensure that they have surrounded themselves with the appropriate business expertise and support.
That's right.
And have a really strong risk management framework to help inform their overall portfolio management.
Yeah, it's actually a bad sign if they think they can do it all themselves.
Exactly.
Yeah.
Yeah, some of my favorite questions that I get when I'm talking to managers who are launching a fund, they will ask questions that make it very clear that they have not read their own documentation, and I find that very troubling. Like, you don't know where in your document your management fee section is. You should know that. You should be able to point to it right away. That's just some advice for any of the new managers out there. Okay, so touching on something that Preet had brought up, which is alignment. New managers, existing portfolio managers who are launching new products within a space, they're all looking to conserve capital. It's very expensive. The cost barrier to enter this space is very high. And anywhere that you can cut costs, managers like to do that. And that makes a lot of sense. But on your side, you want to see more gold-plated kind of application and operational and administrative efficiency. So how do you align those interests? How do you think about that? Or anyone want to take that one?
Chris?
I was going to say, yeah.
Chris, okay.
So core to our model is really the realignment of those fees between the GP and the LP. That's really why our LPs have come to us, is to help do that. So at its core, and Preet mentioned this earlier, just making sure everything is aligned. And so when we're sharing in the economics of the business, those economics flow through to the benefit of our LPs. So they are now hyper incentivized to help that fund manager and that founder build and grow a business, diversify its client base, make it stable, no pun intended. And so for us, the core of our business is kind of that realignment of fees. That being said, I think there's I'm a recovering endowment guy, and there's always a push there to grind on fees. But the reality is the requirements to run the business today is a lot more expensive than it was 10 years ago. To get that Alborn stamp of approval, you need a full team. You can't have the portfolio manager also being the head of IR, who's also the COO, who's also middle and back office. And so to have a high quality team, that's pricey. And so how do you pay for it? And there's that balance that you have to find between the GP and the LP, and that's kind of where we come in to help realign it.
Are there any, well, maybe put differently, do you ever find that managers are spending too much on services that they don't necessarily need for day one? Like, do you need an outsourced everything?
Every single time they spend too much. That being said, they've only met with one vendor. So part of our operating partner model is to go and say, hey, listen, here's 5 other options. Here's actual market pricing. And literally within 2 hours of working with these people, we're saving them hundreds. And they've just never done it before, right?
Exactly.
We now have 34 proof points of founders we've worked with. And so the market dynamics and the economic savings alone is quite helpful.
Okay. Anyone want to add anything on that?
I mean, he's got it nailed, right? If we're going to go and start a new business, we're either going to de-risk, so we're going to put them on our platform. So I'm taking over all that infrastructure risk and everything like that with partners that I know and I care about, right? If I'm going to seed somebody externally, I partner with somebody that's going to take the time. I don't have enough time. Our team doesn't have enough time to get them their auditor, get them their risk manager, all those kinds of things. But they need to have them, so you need somebody to be watching the shop.
Okay, so we touched a little bit on fees. Let's talk about performance fees. How do you guys think about that? Are there any metrics that you require, hurdles, preferred returns, anything like that in order to align interests?
I think it's kind of surprising to me that we don't have like a cash hurdle. Like it's and I think where it started was pre-2007. There's a lot of alpha available, call it in that period of high interest rates, and hedge funds had 1.5 and 20. And I feel that legacy structure just stayed. So when interest rates were low and say markets are getting more competitive, people didn't change that, and LPs really didn't complain because cash was at 0. But now you see like cash going to 5, and it's a lot more competitive, and the alpha's gone down over the last 2 decades. And so to me, it is kind of surprising that we don't have cash hurdles for most managers. And I do think that, when you look at newer managers, those conversations are now happening. So I think as we go with time and interest rates sort of settle in at, let's say, 3%, probably in the next few years, even the legacy guys will probably feel, just as an example, I was talking to a manager yesterday who said, he agrees with me philosophically, but the reason he doesn't want to change is because the industry is at 1.5 and 20.
Bad answer.
Yeah.
Bad answer.
Terrible answer.
And so, they don't want to be off it's a really bad answer, but, that's kind of how people are thinking, is that if other people aren't changing, I'm not going to change.
Right. Well, managers don't like to rock the boat.
That's
another way to think about it. Understandably so.
But it's not really an alignment of incentives.
Couldn't agree with you more.
Yeah.
Yeah, so we've done it, so we run our long-only book too, and we've been very successful in our long-only book, multi-period crystallization. So 2, 3 years, I don't want to pay a big incentive fee and then them kind of have a drawdown the next year. So multi-period crystallizations have been huge to us. But to be fair, if I had 100 units of political capital 5 years ago, a hurdle was not what I was spending it on. I was spending it on something else. Maybe just at lower outright fees, but that's not what I was spending it on because rates were really low. There was very little value to it. Now there's a lot of value to it. So everything we're talking about has a hurdle attached to it. So there's certainly that. We also kind of shift the payout structure a little bit. We're willing to pay a little bit more trade management fee and incentive fee a little bit because, sorry, it's a little bit of a secret, but managers think they can do better than they actually do. And so they're willing to trade that suboptimally, we've found. So we can pick up a little bit of convexity in our fees that we pay by trading incentive fee for management fee. Yeah.
And then I think philosophically, although we have some different views around the table, but personally I really like paying relative fees and ensuring that we're not paying managers for beta, that we're really focusing on compensating them for the alpha that they're generating.
Chris, anything you want to add?
No, I mean, our business is aligning it through the fee revenue share.
Yeah.
Just passing that through to the LP.
Okay. So let's change gears. Do you think that market dislocations are a good time to find talent, a bad time? We've been through a cycle or two. Anyone have any thoughts on that? Karen?
Yep, no, I think market dislocations create opportunities, both for GPs to find better talent. I was speaking with a venture manager earlier who's relishing the opportunity to grow their team and hire from some of the best managers in Silicon Valley in this environment when venture's a little bit more challenged. And I think it creates opportunities for LPs too, that we're looking at a hedge fund that's been closed for a long time and other LPs that have liquidity challenges are forced to redeem. And so we can be providers of liquidity and increase the talent of our manager roster in more challenging environments.
And I would add, I think the data supports that. So we have a white paper called Project Legends. We've done it in hedge funds and in private equity. So taking the top 50 hedge funds, top 50 private equity firms, over 90% of them were actually founded in a period of stress or dislocation.
No way.
And if you think about it anecdotally, it makes sense. If you're a great investor, you're buying your time, you're waiting for that opportunity to leave your shop and start your own firm. And when you see that fat pitch come through, then now's the time.
Exactly.
So we see it in the data.
I think the other thing is also, you have folks sometimes stuck at a firm where they know they're not going to get incentive comp for a while. And so the number two will want to leave and take advantage of a new portfolio. So I think in those cases, my colleague is currently looking at a real estate manager who's spinning out of a large shop. And so dislocations can create those kind of, opportunities for new talent.
Got to find them. We're pretty much out of time here, so I don't know if you have any final thoughts anyone wants to add, but thank you so much for participating today. And everyone in the room, these 4 people are going to be around for the next few days. I will also be around, so if anyone wants to speak to a lawyer, just come and find me.
That's a very expensive conversation.
Should give you a fee break.
Yeah, exactly.
Anyway, thank you so much.
Thank you, Shelley.